Welcome back to our channel. Today, we're going to bust some common myths about dividend investing. Dividends can be a fantastic source of income, but there's a lot of traps out there. By the end of this video, you'll have a clearer understanding of how dividends work and what to look out for. Let's get started. First, let's define what dividend is. A dividend is a portion of a company's earnings distributed to its shareholders, typically in the form of cash or additional shares. Companies pay dividends to share their profits with investors, and the amount paid is usually based on the number of shares an investor holds. Dividends are often paid on a regular basis, such as quarterly or annually, but the frequency can vary. Now here are 6 dividends myths to take note of. Number 5 is totally going to surprise you. Myth number 1. High dividend yields are always better. This is a common misconception. Firstly, let's understand what dividend yield is. Dividend yield is calculated as the annual dividend payment divided by the stock price. For example, if a company pays an annual dividend of $2 and its stock price is $40, the dividend yield is 5%. A high dividend yield might seem attractive, however. It's crucial to understand why the yield is high. Here's why. If a company's stock price drops significantly, the yield will appear higher. This could signal underlying issues such as financial stress, a clear indication that company is in trouble. When evaluating dividend stocks, it's crucial to assess dividend sustainability and the overall financial health of the company. Look at the payout ratio, which is the proportion of earnings paid out as dividends. Other indicators of a company's ability to sustain its dividends include free cash flow, earnings growth, and debt levels. Companies with strong cash flow, growing earnings, and manageable debt are more likely to maintain their dividends. Look for companies with moderate yields but strong financial health and a reasonable payout ratio. These companies are more likely to sustain their dividends over the long term. Don't rely solely on high-yield stocks. A balanced portfolio with a mix of dividend-paying and growth stocks can provide both income and capital appreciation. This will give you a better idea of whether the high yield is sustainable or a potential trap. Always dig deeper to understand the reasons behind the yield and evaluate the company's ability to sustain it. Don't let the allure of high yields overshadow the importance of stability and financial health. Myth 2. Companies that don't pay dividends aren't worth investing in. This myth is a widespread misconception among some investors. This belief can lead to missed opportunities in high-growth sectors and misinterpretation of a company's value. Here's a detailed analysis of why this myth is misleading. Many high-growth companies, particularly in technology and biotechnology sectors, do not pay dividends. Instead, they reinvest their profits into research, development, and expansion. These companies often deliver substantial capital appreciation, which can offer higher returns than dividend payments over the long term. Companies in mature industries with stable earnings, such as utilities and consumer staples, often pay dividends. While they provide regular income, their growth potential may be limited compared to high-growth companies. There are a number of reasons why companies may choose to reinvest their earnings into the business to fund new projects, acquisitions, research and development, and other growth opportunities rather than paying dividends. This reinvestment can lead to higher future earnings and stock price appreciation. Companies like Alphabet, Google, have historically reinvested profits to drive innovation and growth, leading to substantial increases in their stock prices. Companies may prioritize using their profits to pay down debt, improving their financial stability and reducing interest expenses. A stronger balance sheet can enhance a company's long-term growth prospects. Companies might retain earnings to build a cash reserve, providing a cushion during economic downturns or enabling strategic opportunities when they arise. Investors should consider total return, which includes both capital appreciation and dividend income. A company that reinvests its profits effectively can provide higher total returns, even without paying dividends. Evaluating a company's fundamentals, such as revenue growth, profit margins, return on equity, and market position, is crucial. A non-dividend paying company with strong growth prospects and sound management can be a valuable investment. Income-focused investors might prioritize dividend-paying stocks for regular income. while growth-focused investors might prefer companies that reinvest profits for long-term capital appreciation. Here are examples of successful non-dividend paying companies. Alphabet has focused on innovation and growth in areas such as search, advertising, and autonomous driving, contributing to its substantial market value growth. The myth that companies that don't pay dividends aren't worth investing in overlooks the potential for capital appreciation and the strategic reasons behind profit reinvestment. High-growth companies often reinvest earnings to drive innovation and expansion, which can result in substantial long-term returns. Investors should focus on total return and company fundamentals rather than solely on dividend payments. Diversifying a portfolio to include both dividend-paying and non-dividend-paying stocks can help achieve a balanced investment strategy tailored to individual goals and risk tolerance. If you found this video helpful so far, please click a like button and subscribe to the channel to help it grow. And write in the comment section saying, "I have subscribed." Thank you. Myth 3. Dividend payments are always safe and predictable. Dividends are typically paid from a company's earnings. For dividends to be safe and predictable, the company must have stable and sufficient earnings over time. There are factors that might affect dividend safety. 1. Earnings. Volatility. A company's earnings can fluctuate due to various factors such as economic conditions, industry cycles, competition, and changes in consumer demand. If earnings decline significantly, the company may not be able to sustain its dividend payments. 2. Payout ratio. The payout ratio is the percentage of earnings paid out as dividends. A high payout ratio, close to or exceeding 100%, means the company is distributing most or all of its earnings, leaving little room for error. 3. Debt levels. Companies with high levels of debt may prioritize debt repayments over dividends during financial stress, potentially leading to dividend cuts or suspensions. 4. Positive cash flow is crucial for sustaining dividends. Companies with irregular or insufficient cash flow might struggle to maintain consistent dividend payments. There are also predictable challenges to consider. 1. Economic downturns. During economic recessions or downturns, even well-established companies can face financial difficulties that may lead to reduced or suspended dividends. 2. Sector-specific risks. Certain industries are more susceptible to economic cycles, for example, energy, commodities. Companies in these sectors might have less predictable dividends due to fluctuating revenues. If earnings drop, maintaining the dividend could be challenging. 3. Company-specific issues. Management decisions, strategic missteps, or unforeseen operational challenges can affect a company's financial health and its ability to maintain dividends. History has taught us of examples of dividend cuts. 1. Many reputable companies have cut or suspended dividends during financial crises. For example, during the 2008 financial crisis, several major banks, including Bank of America and Citigroup, significantly reduced or eliminated their dividends to preserve capital. 2. Recent examples. The COVID-19 pandemic led to dividend cuts across various industries. Companies like Boeing, Disney, and many others suspended their dividends to conserve cash amid the economic uncertainty. These lead to the importance of evaluating dividend safety. Assess a company's balance sheet, cash flow statements, and earnings reports to gauge its financial stability. A lower payout ratio generally indicates a safer dividend, as the company retains more earnings to cushion against downturns. Companies with a long history of stable or growing dividends are often seen as more reliable. However, past performance is not always indicative of future results. Understand the industry dynamics and how economic cycles affect companies in that sector. Strong management teams are better equipped to navigate economic challenges and make prudent decisions regarding dividends. While dividends can provide a steady income stream, they are not guaranteed and can be cut or suspended during financial difficulties. Myth 4. You should only invest in companies with a long history of paying dividends. While a history of consistent dividend payments can indicate a company's stability and profitability, it does not necessarily mean it is the best investment choice for every investor. Here's a detailed examination of why this myth is flawed. Perceived safety and stability. Companies with a long history of paying dividends are often seen as safe and stable investments. While this may be true in many cases, it does not guarantee future performance or growth potential. Missed growth opportunities. High-growth companies, particularly in emerging industries such as technology or biotechnology, often do not pay dividends. These companies reinvest earnings to fuel growth, innovation, and market expansion. By focusing only on dividend-paying companies, investors might miss out on substantial capital appreciation. Past performance does not guarantee future results. A company with a long history of paying dividends might face changing market conditions, regulatory challenges, or disruptive innovations that impact its ability to continue paying dividends. Even companies with a long history of dividend payments can reduce or eliminate dividends during economic downturns or financial distress. Relying solely on historical dividend payments can create a false sense of security. Investors should consider the following: total return, which includes both capital appreciation and dividend income. Focusing solely on dividends can lead to suboptimal investment decisions. A well-diversified portfolio should include a mix of dividend-paying and non-dividend-paying stocks to balance income and growth potential. This reduces risk and increases the chances of achieving investment goals. Advantages of investing in non-dividend-paying companies. Companies that reinvest their earnings can potentially achieve higher growth rates, leading to substantial capital gains for investors. Non-dividend-paying companies often operate in high-growth industries where innovation and market expansion are critical. These companies can offer higher long-term returns despite the lack of dividend payments. Myth 5. Dividends are free money. The myth that dividends are free money is a common misconception among investors. This belief stems from the idea that receiving a dividend payment from a company is akin to getting an extra bonus on top of any potential gains from the appreciation of the stock price. However, this view oversimplifies the reality of how dividends work and their impact on a company's finances and stock value. Let's break down the details. When a company pays a dividend, the value of the dividend is deducted from the company's assets. Consequently, the stock price typically drops by approximately the amount of the dividend paid. Shareholders do not gain additional wealth when dividends are paid out because the drop in the stock price offsets the cash received. Dividends are usually taxable, meaning that investors have to pay taxes on the dividends received, reducing the overall return on investment. The idea that dividends are free money fails to account for the reduction in stock price, tax implications, and the opportunity cost of not reinvesting profits into the company. Myth 6. Dividend stocks are only for retirees. The myth that dividend stocks are only for retirees is a common misconception that overlooks the diverse benefits dividend stocks can offer to investors of all ages. Here's a detailed exploration of why this myth is misleading. 1. Dividend stocks are attractive to retirees because they provide a steady income stream, but can also benefit young investors by providing regular income that can be reinvested to buy more shares, a process known as dividend reinvestment. 2. Reinvesting dividends allows younger investors to take advantage of the power of compounding. 3. Dividend-paying stocks are often less volatile than non-dividend-paying stocks. This lower volatility can be appealing to investors of all ages who seek to reduce risk in their portfolios. 4. Inflation hedge. Dividends can help offset the impact of inflation by providing a growing income stream. Many companies increase their dividend payments over time, which can help maintain purchasing power. This feature is valuable for all investors, not just retirees. Strategies for different life stages. Young investors can focus on companies with a history of increasing dividends. Reinvesting dividends to buy more shares can accelerate portfolio growth through compounding. Middle-aged can mix dividend-paying stocks and growth stocks to provide both income and capital appreciation, while retirees can prioritize high-quality dividend-paying stocks to generate a stable income stream. Disclaimer: the information provided in this video is for educational and informational purposes only and should not be construed as financial advice. You should consult with a professional financial advisor before making any financial decisions. Investing involves risk, including the potential loss of principal. Thanks for watching. Don't forget to like and subscribe for more financial tips and investment strategies. Let us know in the comments which dividend stock is your favorite. See you in the next video. Until next time, happy investing.